Hey everyone, and welcome back to Accounting Zero to Hero. Today we're kicking off a 6-part series on IFRS 18, the new standard that will be effective for periods beginning on or after January 1, 2027. So this video is definitely for people who want to have an understanding of the new standard for practical application or for studies, since we will break it down simply for all of you. In this first video, we'll focus on the statement of financial performance, and we'll break down what's changed, what's new, and what you need to know. If you like learning about accounting, consider subscribing to my channel through the links below. Just to give you a roadmap of what's coming in this series, Video 1, which is this video, will tackle the statement of financial performance, breaking down the general requirements of the standard. In the second video, we'll explore the exceptions to the general classification rules, where IFRS 18 gets a little bit more nuanced. In video number 3, we'll dive into management-defined performance measures or MPMs and how IFRS 18 brings more transparency to these non-GAAP measures. In video number 4, we'll explore the rules around aggregation and disaggregation, ensuring you know how to group and present information effectively. In video number 5, we'll examine the impact of the new standard on other IFRS accounting standards like IAS 7 and IAS 33. And lastly, in video number 6, we'll guide you through the transition process from IAS 1 to IFRS 18, covering the rules and the options that are available to us. So basically, what we are going to discuss are the new things that are introduced in IFRS 18. So let's get started with the general requirements of the Statement of Financial Performance. First things first, IFRS 18 replaces the old IAS 1. Aiming to make financial statements more transparent and comparable. One of the biggest change is the new structure of the Statement of Financial Performance. It's all about making it easier to understand where a company's income and expenses are coming from. As I mentioned before, the new standard now refers to the Statement of Profit or Loss and Other Comprehensive Income, or we also call it Statement of Comprehensive Income, as Statement of Financial Performance. That is the new name. However, you know that the Statement of Financial Performance is composed of the Statement of Profit or Loss and the Other Comprehensive Income Statement. So the Statement of Profit or Loss term remains to be officially used, and we will be using that all throughout this video. Under IFRS 18, the Statement of Profit or Loss is divided into 5 mandatory categories. We have operating category, the investing category, the financing category, income taxes category, and the discontinued operations category. This is specifically required by the paragraph 47 of IFRS 18. Specifically, this helps you see how the company is performing in its core business activities versus its investing and financing activities. With this new requirement, we have a more clear guidance on how an income statement should be arranged, unlike before with the old standard. Take a look here at an example statement of profit or loss from the illustrative examples published by IASB. We will discuss each new section in this video. You will see that the first portion of the statement of profit or loss composes the income and expenses of the operating category. And then now we have a section for the investing category. We have a section for the financing category, the fourth section of the income tax category, and then the discontinued operations category. All those categories, the income and expenses, add up to the profit for the period. Let's break down each category in more detail. The operating category. This is the heart of the company's activities. It includes all income and expenses that are not specifically classified as investing, financing, income tax, or discontinued operations. In short, this is sort of a catch-all category. Think of things like revenue from core business activities, operating expenses like cost of sales and administrative expenses, impairment losses and reversals of operating assets, depreciation of owner-occupied assets like property, plant, and equipment, foreign exchange gain or losses on operating items, and any other income and expenses that are not classified as investing or financing. You will notice in the subsequent discussions that investing category and financing category are really very specific according to the standard. They will tell you what are the things included in this. But in the operating category, they will not tell you specifically because it's a catch-all. Whatever is not in the investing and financing, you will put in the operating category. Essentially, if it's part of the company's day-to-day operations and does it fit into the other categories, it lands here. Next is the investing category. This category captures income and expenses related to the following: investments in associates, joint ventures, and unconsolidated subsidiaries, income and expenses from cash and cash equivalents, and income and expenses from other assets that generate independent returns for the business. So basically, the investing category focuses on the asset side of the balance sheet. And this generally includes the income and expenses from the three types of assets that I just discussed, and you can see here in the slide. If you follow that definition, this would generally include the following income and expenses. This is a non-exhaustive list. These are just examples. We have income from equity and debt investments of the company, rental income from investment properties, income and expenses from cash and cash equivalents, and foreign exchange gain or losses on non-operational monetary assets. The key here is that these assets generate returns largely independent of the company's other resources, and they are not part of the main business operations of the company. Next is the financing category. If the previous category relates to the income and expenses from the company's non-operational assets, the financing category are largely coming from the income and expenses from liabilities that are not used in operations. So remember, liabilities. There is a little bit of nuance in how IFRS 18 classifies these liabilities or the liabilities of the business, and we will discuss those in the next video about the specific requirements and about the exceptions. For now, it is good to know that the financing category would generally include interest expenses on borrowings and lease liabilities, directly attributable transaction costs related to the raising and extinguishment of borrowings, fair value gains or losses on financial liabilities at fair value, dividends on preference shares classified as a liability, and foreign exchange gains and losses on financing activities. But this is not an exhaustive list. So any gains and losses relating to the liabilities or the borrowings from the raising of finance generally would fall under the financing category. This category helps you understand the cost of the company's financing activities, specifically the raising or the extinguishment of finance or borrowings. Now, before we move on to the last two categories, it is good to note that now in IFRS 18, there are certain accounts that are previously lumped together in one line item, but are now required to be split according to their nature. One example are the foreign exchange gains or losses of the company. They are not anymore lumped into one account, especially in the mapping and the financial statements, but they need to be split to its related activity or category depending on its source. It means that the forex gain or losses can now have an operating, investing, or financing portions depending on whether the source is from a main business activity or for an investing activity or from a financing activity of the business. This practically has one of the big implications to a company's accounting system, especially in the chart of accounts of a company, because you need to update the chart of accounts to accommodate this new requirement, because some of the income and expenses that can previously put into just one account, you just now have to split them for them to be mapped properly to the other parts of the new statement of financial performance. And this is not only related to foreign exchange gain or loss, but this could also affect, for example, interest income and interest expenses. So the fourth category is the income taxes category, which is pretty straightforward and there's nothing new about it. It includes all the income, tax expense, or benefit for the period as calculated under IAS 12. And we also have the discontinued operations category, the last one, which includes the income and expenses from any discontinued operations as per IFRS 5. This keeps the results of these operations separate from the company's continuing activities. Now, the question is, Are there any exceptions to these general classifications or to the type of income and expenses that I have discussed to you falling under investing and financing categories? The answer is a big resounding yes. IFRS 18 recognizes that some companies have unique business models. For instance, a company whose main business is investing in assets, like for example a real estate investment company. These are companies that would buy real estate and, for example, rent them out to tenants as a main business activity. It wouldn't present a useful picture of its operations if the rental income from their investment properties were classified under investing, because that is what the general requirement is saying. And their main business activity is actually renting out the properties, so this rental income should actually go into the operating category. There are other special rules for companies with specific main business activities, allowing them to classify certain income and expenses differently to reflect their operations better in the statement of financial performance. We'll delve into these exceptions in the next video. But wait, there's actually more. IFRS 18 also introduces two new subtotals that companies are required to present. These are the operating profit or loss, here, and the profit or loss before financing and income taxes. Now, if you add all of these 5 categories we discussed, the total is called profit or loss for the period. This one, profit. However, IFRS 18 specifies that in the breakdown of the profit, you should present the operating profit, which is the subtotal of all of the operating income and expenses. You should also present profit before financing and income taxes, which is the total of operating profit plus the investing category. You will notice that the standard is not really requiring companies to present subtotals of investing and financing category, unlike what they did with the operating profit. But it really depends. The standard is giving a little bit of flexibility on the other subtotals as long as it gives an opportunity for the company to present a useful and structured summary to the users of the financial statements. However, it is already saying that the new required subtotal is operating profit and profit before financing and income taxes. Definitely this should appear. These subtotals provide valuable insights into the company's performance, because the operating profit or loss shows how well the company is doing in its main business operations, while the profit or loss before financing and income taxes helps you analyze the company's performance before taking account how it is being financed. Well, that's a wrap for our first video on IFRS 18. We've covered the major changes to the statement of financial performance, including the new categories, subtotals, and the importance of clear classification in the financial statements. Stay tuned for our next video where we'll dive into exceptions to the general classification rules we just discussed. Don't forget to subscribe, like, and share this video with your fellow accounting learners. Bye!